Okay, welcome to the Franchise Freedom Podcast. I'm your host, Giuseppe Grammatico, your franchise guide. And today we have a very special guest. Today we are speaking with Sean Tepper. Sean is the CEO and founder of Ticker, a platform that gives beginner as well as advanced investors the power to manage your own investments and beat the market. Ticker has proven to generate consistent returns between 15 and 50% per year compared to the average return of 6%. Sean, welcome to the show.
Giuseppe, hey, thanks for having me.
Thank you. So yeah, we were just talking before. This is our first episode on StreamYard. So we're going to see how things go and going to invite you back for a live version of the show. So very excited, and first show of the year as well. So a lot of good stuff.
Awesome.
So Sean, tell everyone a little bit about yourself. I just read your brief bio, but specifically what you do and a little bit more about Ticker.
Sure. Yeah, my background is about 15 years in software engineering. And the first 5 years, I had a service business where I was building software applications, websites, and all kinds of technical stuff for small, mid-sized businesses. And that company went through a merger in 2010. And that was a moment in my life where I knew if I really wanted to build wealth, I had to kind of get beyond a service business a little bit and start looking at ways to generate residual income, or at least use compound interest in my favor. So what I did is I started getting into angel investing. And for those who know about angel investing, it's very similar to VC investing, where you lose money about 90% of the time, but you hope your 10% wins make up for those losses.
Right.
So, right. And I made some money, over the next 5 years. So that was like 2010 to 2015. And it wasn't anything great. Like, the goal was, of course, to build a tech startup and sell it for 10x revenue. Needless to say, a lot easier said than done. So that was a moment when I said, you know what, let's see how we flip this equation so we can win 90% of the time and lose 10%. So I looked at the public markets, and I knew guys like the guys we respect, Warren Buffett, Charlie Munger, Ray Dalio, David Tepper. These guys, they can make consistent returns, especially if they are managing their own money. In fact, Warren Buffett has said he could make consistent 50% returns a year if he's just managing his own money. And I thought, okay, so how do they do that? They're not guessing, right? They're not using emotions. They're not gambling, which means, my background in software engineering leads me to logic. This means they're using math. So I read as many books as I could around 2015 and started writing an algorithm. And I have to give credit to these guys because I really used what they had and just put it together. But that first year I made 15%, and I had no intentions of creating software. I'm like, I just want a tool that can remove my emotions from the equation, because I don't want to sit there and guess and hope a stock is going to go up or down. I want to use math to make the decision for me so I can just sleep at night. So that's essentially what I created. And I just played with this algorithm the next 4 years, essentially, probably 1,000 different iterations, just playing with this thing on the side, and ended up making between 15 and 50%, given we have a good market the last few years, but still I was able to beat the market every year. And then in 2019, things got really interesting. I started talking to some wealth management institutions and some family practices, wealth management practices, and showed them what this algorithm can do. And they told me, you got to test it through the recession. And this is where things got really interesting. I tested against 2008 S&P. That year went down 38%. Ticker that year was up 24%. Then in 2009, S&P 500 went up 23%. Ticker was up 72% that year. And then in 2010, the S&P 500 kind of leveled off at 12%, and Ticker was up 96%. So I knew at that moment I definitely had something here. And that's when I just went into software engineering mode and started to create a tool for other people to use. Prior to that, I was doing everything manually in Excel. It would take me about 5 to 10 minutes to analyze one stock. It was very laborsome.
Yeah, I'm sure it saves a lot of time, right? Setting up those algorithms, and I can't even imagine.
I would literally set aside an hour and just look at a handful of stocks and see if they pass or fail.
Right.
In most cases, they had failed, but every once in a while, I get a good one, and I invest in that and go from there. But yeah, that brings us to today.
That is amazing. And yeah, as we were talking before the show, and in the past, I was on your show as well. I come from the investment world, so it's always been a love of mine, an interest of mine. And it's interesting what you said about Warren Buffett, how the returns he can make. And I think the good is that he has a lot of cash on hand. The bad is I think it's also, I guess, sometimes an issue, right? Because now that he has all this money coming in via Berkshire and his various investments, sometimes he is forced to invest the money. Maybe it's not the ideal time. So I think there's just so much cash coming in. But to your point, was a big fan of behavioral finance and just taking the emotion out. And I could say personally, when I was in the investment world, I would check my portfolio multiple times a day. I rarely check. I mean, I'm at the point now, I'm so busy with my business that I check maybe, I guess, when the monthly statement comes out, and I notice my returns have gone up because I don't make foolish decisions because I panic because the market's up or down because of something that was on Fox News or CNN or some headline. So I personally, for buy and hold, just try to avoid looking at it as much. So
that's good.
So that brings us to something we were talking, and I wanted to bring this up now because I think this is really important. Is we talk about asset allocation, and a comment I made to you was that I think people get a little confused when it comes to asset allocation, in that they feel they own stocks and bonds and they're properly allocated, and that's good for that particular space. But there are so many other vehicles, and I'm not saying you have to invest in all vehicles, but you should always explore. So the example I give is a business is an investment vehicle, right? It's going to generate cash flow and returns when you go to sell it, stocks, bonds, mutual funds and things like that. But one thing we were talking about, and I definitely want you to discuss even further and comment, is, if someone came to you and made the argument, okay, I own a business, my business, I'm a coach, consultant, what have you, and I have 10 different revenue streams, and that's the way I diversify. So therefore I justify by not investing in the stock market. I do not recommend this. Full disclosure, I have a business, I invest in the market as well. But what do you say to someone that thinks they're fully diversified in the business, just the business that they're in, and does not invest elsewhere?
Yeah, I have to speak from experience, not my own experience, but talking to guys that have been there, done that. And they will literally not invest anything into ETFs or index funds or the stock market. They won't invest in real estate. They will literally go all in on the business. And even if the business is doing well today, hard times can hit and markets can change. Competition can come up. COVID, for example, your entire business can be pulled out from under you, and you're not going to be able to sell it, obviously, in most cases. You lose your revenue, and then what do you have? And I've actually run into men and women well into their 50s, nearing 60, 65, and the business is gone and they've got nothing in investments. It's like you're starting from zero. And my advice is don't do that. You want to, great, you've got a business, it generates revenue, but you want to be taking your profits and investing in other assets like the stock market or real estate. I get a lot of people who invest in real estate on my podcast, so I'm definitely a fan of that asset class as well.
Okay, no, it's great. And I could not agree more. The show is called Franchise Freedom. It's not always the right fit for everyone, but we talk about you have to always look at the big picture, because at the end of the day, you can always add on a partner. Maybe you start the business, you sell half off. But a lot of people do rely that from my experience and from what I've seen is they start the business, 10 years later, they go to sell, and we hit a market like we had last year, 2020, and they see the value of that business deteriorate very quickly just because of what happened. Maybe they lost a lot of their clients and things like that. Right. So yes, it's a true diversification strategy is to own a little bit of everything. And my firm belief, and I can't remember the book, and it was a investment banker on his deathbed. He had what did he have? He had cancer. He had 6 months to live. He wrote a book, and the name of the book escapes me. And he wrote the book with a financial advisor and just talked about investments and things like that. But he made one good point. He's like, there's so many investments just because the investments exist. One of his points where you don't have to invest in it. Just because you can buy or sell gold and silver and various other precious metals doesn't mean you ever have to own it. Maybe you own it indirectly, maybe, one of the holdings, a mutual fund, but he just talked about really understanding, and that's kind of Warren Buffett's philosophy as well, right? Truly understanding the business model, or else, not getting involved. So, with that being said, and we could talk investments forever because it's a great interest of mine. So tell I guess a little bit more about, obviously you have there's the algorithm that we had discussed. So how does it all work? So someone does approach you, they want to invest money. Are there different algorithms based off of risk tolerance? Can you talk to everyone a little bit more about that?
Yep, I'll give you a little context here, and I'll try to simplify it. So, Ticker is what's classified as a stock screener. So it's a tool that finds stocks for you. It's not your broker. A broker is where you add your bank account and you can transfer money to and from your bank account, so you can actually invest and buy stocks. So mine doesn't do that. It's just a screener. And how it works is Ticker is really focused on value investing. And just as you know, but this will be a good overview for everybody listening, is there in the stock market, there's four, and most people do as well, there's four investment strategies. You have value investing, you have growth stock investing, you have dividend investing, and you have speculative investing. So like growth stocks are really high flying stocks like your Teslas, right? Mm-hmm. Of the world. Value stocks in comparison are usually pretty boring businesses. They have great financials, they're safe businesses, and they're not going to get you like Tesla was up 700% over the last 12 months. Ticker's not going to do that for you in most cases. Can you go 15 to 50% consistently? Sure. That's what I've been using it for. Again, finds very boring businesses, and it usually fails, or in the software it classifies it as overpriced growth stocks as well as speculative stocks. Now, speculative stocks that's where most people lose money. They're the shiny object, right? Mm-hmm. People get attracted to them. Remember a few years back, the marijuana stocks were all the craze, right? Everybody was going in and then they went to zero. Right. It's scary. So fortunately, Ticker steers people away from that. So it's just really focused on value investing. And I'll give a little context on the algorithm. So it's based off of Benjamin Graham is the one that came up with the sticker price. And long story short, you can determine the real value of a stock. And of course, we can all see the share price. Share price and real value or intrinsic value are different. Right. And you have to use, like what I use is the EPS growth rate and other variables. I won't give it away, but it allows you to determine what is the real value of a stock. And an example is like Microsoft today is, I think, around 200. Let me do a quick check. 219, and the intrinsic value is around 1,000. Mm-hmm. So there's definite. Actually, I'm sorry, it's not 1,000. It's around 400. So it's about double the price. And what Benjamin Graham taught Warren Buffett, his one of his main students, was you want to make sure you buy a stock that's 50% off the intrinsic value. So a great example is, let's say a stock is $100 and the intrinsic value is 200. There you go, 50% off. So what I do is I go a step further and I add a layer of rigor to it. So you can't just make a buying or selling decision based on the sticker price. I added a point system from 0 to 20. And what that does is it analyzes the return on investment capital, which in layman's terms is really how is the business using the revenues and profits to invest in more profit for us as shareholders. It looks at the sales growth rate, the equity growth rate, the cash on hand, And a few other variables. But anyway, the higher the score, the safer the investment. In other words, the stronger the financials. So it's calculating that margin of safety, that intrinsic value I just talked about, and then this point system. And the point system is something that nobody's really done before. I actually got a patent on this. So I'd be one of the first, but I needed a way for me to just feel more comfortable about the investments. So that gives you a little background there without getting too deep into the weeds.
Yeah. No, so I guess my follow-up question would be, who is your customer? So is it, is your customer the average investor that's working with the financial advisor, or is that investor investing directly, through via an E-Trade account?
Great question. So when I started talking to institutions and family practices, I found that a lot of them, it can be very difficult for a wealth manager or a financial planner to buy individual stocks for all their customers. If you had like 10 customers, maybe, but a lot of these firms, they've got hundreds, if not thousands. And you can't be like buying individual stocks. It's very time consuming. So that's why they usually buy index funds, mutual funds, and ETFs for their customers. You can buy it, set it, hold it. There you go. So it's easier. And there's nothing wrong with that. That's fine. I serve the self-directed investor. It's also called the retail investor, which is about, it's about 54 million people here in the US, which is roughly about 15% of the population. And this is really interesting. I'll share some cool stats. Is the self-directed segment in the US is growing by 5% a year over the last few years, whereas the wealth management industry is growing about 1%. So it's growing 5 times faster. And the reason is 2 reasons: podcasts and YouTube. What's happening is people are finding out they can manage their own investments on their own. So I decided to go that angle. I'm going to serve the retail investor. And I started doing homework around the world to see if that's very similar. So get this, I fortunately have customers from all over Europe, so Germany, the UK, France, but also in Asia, so China and India. I've become friends with a lot of these customers, and a few investors in India filled me in that, hey, our self-directed segment is growing by 20%. It's incredibly fast. Yeah. So Ticker I'm rolling out globally, so releasing foreign stocks on the tool by the end of the month. And then I've got a mobile app coming soon for Android and iPhone at the same time. So everybody around the globe can use it. And of course, you can see stocks in your own currency. So really capitalizing on that market.
Right. Wow. That's very, very impressive. So what, if you don't mind sharing, if you have that information, what I guess the average return was last year, and, any thoughts 2021, a lot of stuff going on, obviously, we're continuing with COVID, a new president coming on board here in a few weeks. Any predictions, any thoughts, any advice for the average investor?
So yeah, I'll give you a little background here. This was 2015, 16 through 2019. My returns were consistently 15 to 50%, just using Ticker to buy very boring businesses. But in 2020, things got really interesting. The COVID, I call it the COVID dip, which hit in March and April. And I'm very familiar with a lot of the strategies top investors use. And my mentor, and I give him a lot of credit, is Phil Town. He wrote 2 books. One is Rule 1. The other one is Payback Time. And he talks about the most powerful investment strategy you can learn is called, it's really buying when the market is fearful. And it's a strategy that I applied to March and April. And what I did is I just watched the market go down. And what you do is you buy, because you can't time the bottom, like the very, very dip, but you can buy into it. And I usually say you want to watch as your stocks fall about 5 or 10%, and then buy more. Watch them fall 5 or 10% more. So I just kept buying as the stock market went down. And what's important is, and this will give you a little context here with how Ticker works, it's very definitive. There's a lot of screeners out there that are very ambiguous with their decisions. They give weird rating scales and it's hard to read. So Ticker is really on sale, watch, overpriced. On sale is a buy, overpriced is a sell.
Mhm.
So as my stocks continued to fall, but they remained on sale, guess what I did? Just kept buying more. Bought all the way down within a few months. This was by summer, I was up about 80%, but the market kept climbing. And this year, total returns, my entire portfolio, not just individual stocks, total portfolio return was 120. So first year I went 3 digits. Am I going to hit that in 2021? Only if we see another big pullback, then I'm going to buy down into it. But otherwise, I would expect I'd probably continue at that 15 to 50%. So we'll see what happens. I don't think anything drastic. I really feel like the vaccine is adding a lot of positivity to not only the US market, but globally. I think that's going to help. I don't really see a big deal about the stimulus. It's an emotional trigger. Is it really going to make an impact on your personal investments? No, but I think if we don't get it, I don't think it's going to hurt us too bad. But if we do, great. I think it'll add more positivity. But I think we'll be all right this year. I really do.
Right. Yeah. I mean, it's investor confidence, right? I mean, as long as you mentioned, the vaccine, people are becoming more and more positive. I mean, there's the debate of who's going to get it and who's not getting it and all that. But, there's some light, I think, at the end of the tunnel, which
right.
excites people. And, obviously there's going to be a better outlook. So, no, great, really good information. And those returns are, obviously phenomenal. And, kind of going back to the diversification, and we talk a lot about this when someone does, working with someone that does invest in a franchise. I always say, I always will give a recommendation of someone to speak with, or they may ask me, who's your merchant services, or, who's a financial advisor? And I talk to them about setting up some type of retirement plan, whether it be a SEP IRA or a solo 401k, whatever their situation is, but and that's your diversification, diversifying, putting money away for your employees as well. You want to retain your employees. That's kind of the lifeblood of the business. And investing in the market. So it's nice to have contacts like yourself and tools and companies like Ticker that could really maximize the returns in the market, right. which is huge. I mean, I've been out of the industry for a while, so it's these conversations really get me going and interested back in the market. So, someone that does have some interest, what is the where do they start? Do they go to your website? Do they contact you directly? I guess walk us through what a new customer or someone just that wants a little bit more information. Where do they start?
Yeah, so I made Ticker a really low barrier to entry, very low risk to get started. You don't even have to add a credit card. It's free, 14-day free trial. And the idea there is just get in and start using it. Start playing around right away when you join. You get a welcome newsletter, and it provides you with a PDF. There's actually a few PDFs, but one is like 20 tips that you can use right away. So just so you maximize the power of Ticker, and some of them include like, hey, how do you invest your first $1,000? Or what happens when the market is crashing? When do you know when to buy? When do you know when to sell? Most people don't know those trigger points. But a lot of pretty basic stuff that will allow you to get started very easily. I mean, this PDF, you could read through it in 5 minutes. You're going to be highly, I would say, highly dangerous. You're going to be pretty effective to do some damage in the market, or at least increase your returns. But yeah, it's easy as that. Is just go to Ticker's website, and you're going to be entered into an email sequence that's going to provide tips. Right. This PDF that's got the 20 tips, you get a new tip every day. So it's kind of like the reminders, like, hey, you should be thinking about this, thinking about that. So it really kind of holds your hand along the way to help you get ramped up.
Which is nice, because you're not giving them all the info at once. It becomes sometimes a little bit overwhelming to absorb it all, right. Especially if it's a new way of thinking. What about the novice investor? Maybe the investor that just started. Is this would this work for them as well? Easy to understand.
It's actually, I can't like lock in a percentage, but I would say the majority of the people joining are brand new investors. Okay. At least 50 to 60% have never invested. And I get emails from people all the time. They're like, I was always intimidated by this, never knew where to start. This is just cutting through the noise, because it's not only a screener, but this is one thing I really focused on in software engineering, is when you build good tools, they should be really easy to use. They should be intuitive. Like if it just drives me nuts when I use a new software program and I'm like looking around for buttons or trying to do this or that. Like it should be so simple, like an Apple product.
Yes,
Right?
absolutely.
Yeah.
And on top of it, which is a big plus in my opinion. So this, I'm on the consumer side, right? So I'd be the person signing up. No credit card required to start. Some people don't like that idea. They just want to try it out. StreamYard, perfect example. We're using StreamYard. No credit card required. Try it for a couple of weeks or whatever it is, and I think, or maybe it was a week. And then once you're ready, it's always free. Their basic version, which didn't cover everything I needed. So then it's whatever the monthly fee is. So no strings attached. And this is great. And so what is? I'm going to put this all in the show notes. What is the website address for Ticker?
Yeah, it's ticker.pro, and the name is TYKR. TYKR.pro. The .com was taken.
Oh, really? Okay.
As you could imagine, yes. There's no actual ticker.com out there. If you were to go search, somebody's probably sitting on it on GoDaddy, but yeah, just ticker.pro.
Curious what the resale, what they're selling that for.
I'll try to buy it someday.
Right. And if someone does have a specific question for you, do you advise to contact you directly, or do you just advise them to go to the website and submit a question there? Or
Yeah, just go to the website. There's a contact form. Everybody, that's interested in getting in touch, they just go through that. And I'm usually pretty responsive. Within 24 to 48 hours, I can get back over the weekends, but during the week, I'm on top of it. So yeah, any questions? You want to talk stocks? One guy actually, he wanted me to review his portfolio, and I'm not an advisor, of course. So I preface that up front, but I just looked at it and gave my comments. So it's fun.
Yeah, there's a lot of equities out there, right? So obviously,
yeah,
I'm sure you'd get that question quite a bit. No, really, really good stuff. We'll put that all in the show notes. So I guess switching gears a little bit. So, a lot of people on the show, they are corporate execs. They are people that have been recently furloughed. They've been laid off. So either furloughed, laid off, their offices shut down. Maybe it's in New York City or Philadelphia, and maybe they don't want to go back. So this has kind of been one of those events in time where you're like, you know what, I've dreamed of maybe owning a business like yourself, like myself. For all those people in career transition, what advice, what's some advice you would give to them, and to add to that, what's some advice you'd give to your younger self? You're a young guy, but your younger self.
Sure. Yeah. You know what? I think it's really important. I should have did this with my first business shortly after college. Was, like I said, a service business. And if you really love providing a service, whether you're an accountant, a plumber, an electrician, an attorney, a software guy, and you like providing a service, you should love that service. You should absolutely love it. And so if you're going to provide a service, great, go do a service business. But like me, I wasn't in love with building large volumes of software projects for people. I always wanted one platform that's scalable. So a SaaS, which Ticker is, a software as a service, that's where my heart always was. And I should have known that earlier. Like I should have figured that out. I would tell myself, like, hey, here's the pros and cons of a service business. Here's the pros and cons of a software business, pros and cons of product, and lay it out. And this is a conversation that you and I kind of had, when you were on my podcast, is you want to really figure out what kind of lifestyle do you want? Do you want a business that, keeps you busy over the weekends, or do you like a lot of family time? Do you like hobbies? And you want a business that complements your interests, right? Do you not only like the business, but like, let's say it's a 9 to 5, so you get off work and you can spend time, you can have dinner with your family, right? If that's important to you, you should think about that type of business before you get into it. Don't think about the money, think about the lifestyle, because the money will come. And that's what I've learned in business. It will come, but think about the lifestyle.
Yes, I definitely agree there. And I've made some of those mistakes where you're almost chasing money, like what's going to pay me the most. And that's short lived, right? It gets old, you burn out, and it doesn't last long. It's not sustainable. It's like when I was on your show, what's the hot franchise? It's, what who cares? What's going to be sustainable? What's going to match what you're looking for? So I have a lot of those conversations, and I don't say it to be rude, but it's just I call it tough love. It's just like, you need to hear this. Sure. And it's, you may not believe it, or it may take a second to really absorb and appreciate. But it's tough love, and it's advice that needs to be given, and those conversations need to be had. So, this has been great. Anything else that you'd like that we didn't cover on the show? There's a few more questions, but anything else we didn't cover that you'd like to bring up?
I think you really, really covered it. I think, if anybody listening out there is interested in investing in the stock market, I have to say this, like, once you figure out how to leverage compound interest in your favor, where most people are fighting it via credit card debt or some kind of debt. And unfortunately, that's the way the world works today, is you're constantly fighting. But if you can flip that equation so compound interest is working for you, your life, your finances really gets a lot easier. And I got to tell you what, the number one place that compound interest is working for you, it's your friend, is the stock market. It's incredible. And it may seem slow in the beginning if you start with 1,000, but just be patient. That's the key word, is be patient. And just over time, you're going to see this building and building, and then the snowball effect is quite impressive. So, that's the last bit of advice I'd have there.
I agree there. And yes, you do have to be patient. And I tell that to a lot of people. It's not going to happen overnight, but it's amazing. Once the account balance starts growing and you're getting that rate of return, and you look at the compounding effect, it truly is amazing. And then it's you get the conversation is, I wish I had started sooner. I wish I had put more money aside. And it's, we have these conversations, not because, yes, we know now, but, I want to save the 20-year-old or the 18, 17-year-old, however, whatever age they are, to start and really realize that even if it's, you're putting away $100 a month and, that's only $1,200 a year in savings, what the returns could look like. And there's a huge difference between 10% annual return and, and then you look at it, if you're compounding something monthly, and you look at those, the amount. So what is it? So if we put even numbers, 12% return versus 1% every month, I forget the difference. And I had done the math once years and years ago, back when I was in the financial world, and it was amazing to show just compounding and what that can do. So now really, really good stuff. And as I mentioned, I'll put the website on the show notes, and encourage everyone to check it out. 14-day, you said, free trial, no credit card needed.
14-day free trial, you bet. Yep.
And education wise, is it also a great place for the novice, just trying to get in for education? Or do you recommend any other resources for them to learn a little bit more about the market?
It's the education and the tool all in one. So when you join, you're going to get all the good content. I do have a sequence that sends out to everybody. I mentioned his name earlier. Yep. He's got the 2 books. So it has links, but anybody listening, of course, check out Rule 1 and Payback Time. Highly recommend.
Cool. Very good. All right. I'm going to copy some stuff from you in a couple other episodes, and I'll keep them brief. But someone asked me this the other day, if I can actually speak. How do you take your coffee if you drink coffee in the morning?
I'm not a coffee drinker, but I like green tea. So
green tea.
You give me a cup of hot green tea every morning, I'm good to go. Yep. Cool.
Number one vice, what's your go-to?
Number one vice. I'm thinking here.
Could be food. I know for me, we were talking food was pizza for me yesterday. So
I love ice cream. Absolutely
cream?
love it. Yeah. It is my weakness.
Yeah, we had tried. We got introduced to mochi, which I didn't realize that they had a ice cream version because I've had the non-ice cream, and definitely addicted to that. So we talked about our workout regimen, and between the pizza and that's not helping at all. So
yeah.
And I think this was yours yesterday, and this is I'm stealing this because I'm actually redoing the show. New platform here, new questions.
Sure.
Last one. Number one way to unwind after work.
Oh, I'm an outdoors guy, and I definitely value work-life balance. So I've got a few things. I'll rattle them off. Like right now, winter. I'm looking outside now. It's like snow everywhere in Wisconsin. So I do a lot of cross-country skiing. I'm not very good. Like I just picked up the hobby last year.
Right.
But yeah, I like that. Otherwise, I do a lot of mountain biking during the summer and fishing, boating. Get me in water. I'm happy.
Right. And that's awesome because it also counts as exercise, right? So keeps
right.
you in shape. It's fun. It's healthy. So
yeah,
that's awesome. Well, listen, Sean, I really appreciate your time. I know it's Friday here. We're approaching the end of the day, and I really appreciate. It was a pleasure and an honor being on your show, and I'm glad. Been looking forward to this. I know we were planning on trying to have it around Christmas time. It got a little bit crazy, so very excited to get this posted. We'll get you on again for a live.
Sweet.
Funny not story, but funny thing that happened today. I was on someone else's podcast. Luckily, that was not live, and my smoke detector started going off for 15 minutes. So, it's
timing.
Yeah, the timing. I mean, exactly at the time we started.
Yes.
So, and so learned quickly how to shut off. Not quickly. It took me a while to scrambling how to shut them off. So yeah, I think the live aspect kind of livens things up, makes it interesting. And
sure.
Hey, the mistakes are great. Makes it more natural and
makes you real. You're approachable.
Right. You're right. It's real. It's approachable. And I truly enjoy it. But once again, I appreciate it. Have a great weekend, and we'll definitely look forward to our next conversation.
Thanks, Giuseppe. This was great.
Take care.
See ya.